Welcome to This Explainer. Today, we're firmly putting on our value investing hats. Really channeling our inner Warren Buffett or Charlie Munger. We are going to ruthlessly dissect the 2026 balance sheet of an absolute behemoth of a global corporation, just to see what's actually under the hood. We're not here to talk about their flashy marketing campaigns or recent stock price momentum. No, we're looking strictly at the cold, hard numbers straight from their 10K filings to evaluate capital preservation, real durable competitive advantages, and how well management is truly stewarding shareholder capital.
Look, we all recognize this iconic brand, right? It's literally a staple in households all over the world. But today, we're stripping away all that top-line glamour and colorful packaging. What we care about is the financial architecture supporting that famous logo. Is this business built on a fortress-like foundation of hard assets, or is it secretly being propped up by financial engineering and leverage? Well, we're going to find out.
To kick things off, we absolutely have to adopt the golden rule of legendary value investors. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And why does that matter here? Because a balance sheet is the ultimate truth teller. An income statement might show you how much a company sold this year, sure, but the balance sheet? That tells you whether a company is actually building durable, lasting wealth, or if they're just playing a dangerous game of debt-fueled musical chairs.
Let's jump into Section 1, the capital allocation mode, and see how they are funding their organic growth.
So, how is PepsiCo's management actually allocating capital? Does their perceived financial moat hold water? We need to figure out if they're retaining enough earnings to fund their own growth organically. Now, at first glance, their retained earnings look massive, sitting at over $72 billion. But look right beneath that. That figure is heavily offset by a staggering negative $41.8 billion parked in treasury stock. Management has spent an enormous amount of capital buying back their own shares over the years. But you have to ask yourself, is that actually a good thing?
This right here brilliantly illustrates the reality of how they're currently operating. If we break down their cash flows, they generated about $12 billion in operating cash, spent $4.4 billion on capital expenditures, which leaves roughly $7.6 billion in free cash flow. Okay, not bad. Yet they turned around and paid out over $7.6 billion in dividends, plus another $1 billion in share repurchases. Wait a second, they're paying out more in shareholder returns than they actually generate in free cash flow. To bridge that gap, they're relying heavily on debt, including over $8 billion in new long-term debt issuances in a single year.
So, the big question is, are these disciplined buybacks where management is eagerly snapping up a significantly undervalued stock, or are they just masking dilution? Well, just look at the share count. Despite spending $1 billion on share repurchases, the weighted average diluted share count barely moved. It shifted only slightly from 1,376 million down to 1,369 million over 3 entire years. Basically, that billion-dollar annual buyback is largely just running on a treadmill, quietly hiding the equity dilution from executive stock options and compensation packages.
Moving on to Section 2, debt, leverage, and solvency, which is all about the classic sleep well at night test.
Let's apply that sleep well at night test to their liabilities to see if they're bordering on ruin. When you invest in a consumer staples giant, you're buying it for stability, right? Not white-knuckle volatility. Yet, calculating their leverage gives us some serious pause. If you take their long-term debt of $42.3 billion and compare it to total capitalization, which is that debt plus their $20.5 billion in total equity, we hit 67.3%. Carrying nearly 70% of your capital structure in debt, that borders heavily on the aggressive side of leverage, especially for a company people rely on for safety in literally any economic climate.
Fortunately, it's not all bad news on the balance sheet. There's no ballooning maturity crisis here to keep us awake at night. Notice how beautifully staggered their upcoming long-term debt notes are. They have roughly $4 billion coming due per year over the next few years. Management has expertly built a debt ladder, and that prevents a forced refinancing nightmare where a massive chunk of debt comes due all at once in what could be a really hostile, high-interest rate environment.
Let's pivot to Section 3, liquidity and asset quality, looking at how well they can convert assets to cash.
You see, not all assets are created equal. $100 billion in assets means absolutely nothing if you can't quickly convert them to cash in an emergency. Looking at liquidity, their quick and current ratios are admittedly tight. Both are sitting comfortably below 1.0, which usually suggests current liabilities actually exceed current assets. But they completely make up for it with raw cash. They hold a fortress-like cash and cash equivalents cushion of $9.1 billion. This is exceptional. It means they aren't dangerously reliant on the whims of the credit markets or their $2.6 billion in short-term commercial paper just to survive day to day. They can pay their immediate bills with cash on hand.
But here is where a classic value investor gets highly suspicious. Out of their $107 billion in total assets, roughly $33.9 billion is tied up in goodwill, amortizable intangibles, and other indefinite-lived intangible assets. Think about that. That's 31.6% of their total asset base, consisting largely of accounting premiums paid for past acquisitions. Why does this actually matter to you and me? Well, tangible book value is the net value of a company's physical, real-world assets. If a severe economic downturn forces impairments on those legacy acquisitions, meaning the accounting department finally has to admit those brand names aren't worth the massive premium paid for them, we really need to know what physical value is actually left protecting shareholders if things go south.
So the crucial point is right here, and it's a jaw-dropper. When you take their total equity of roughly $20.5 billion and subtract those $33.9 billion in intangibles, PepsiCo's tangible book value is actually negative $13.4 billion. There is virtually zero hard asset protection for the common equity holder. The entire business is floating purely on its brand power and future cash flows, not physical asset backing.
Now for Section 4, unpacking the DuPont ROE to find the true sources of their return.
That startling lack of physical asset protection leads us perfectly into unpacking their seemingly incredible return on equity, or ROE. If you just glance at the headline numbers, their ROE looks like it's roughly 40%, which is mind-blowing. But we're going to break that down using the classic DuPont analysis to see where that return is actually coming from. The DuPont model splits this ROE into three parts. First, an 8.8% profit margin. Solid for sure, but not breathtaking. Second, an asset turnover of 0.87, meaning they generate 87 cents of sales for every dollar of assets. Again, good, but standard. The real driver? Step 3, a staggering 5.23x financial leverage multiplier. They have over $107 billion in assets, precariously balanced on a tiny sliver of just $20.5 billion in equity. The stark truth revealed by this math is that this highly impressive headline ROE is artificially inflated by taking on excessive leverage. It's a financially engineered return rather than a return driven by sheer, unmatched operational dominance or ultra-high margins. Let's dig into Section 5, Hidden Risks and Red Flags, by sweeping the footnotes. A good value investor never stops at the main statements, right? Because what you don't immediately see can still seriously hurt your portfolio. The devil is always in the disclosures. Scanning the fine print reveals a few glaring items. First up, their U.S. pension plan has an accumulated benefit obligation of over $7.1 billion, but only $6.4 billion in plan assets. It's underfunded by hundreds of millions of dollars. Second, they have a massive $1.68 billion locked up in supplier finance obligations. Essentially, they're leaning heavily on extending payment terms to suppliers to optimize their own cash flows, which is a strategy that works great, right up until the credit environment tightens.
Furthermore, we spotted a really interesting discrepancy in their working capital. Finished goods and total inventory jumped over 10% year over year, climbing to $5.8 billion. However, net revenue only grew by a sluggish 2.2%. Inventory growing almost 5 times faster than sales, that is a classic red flag, hinting at slowing consumer demand, supply chain miscalculations, or potentially even channel stuffing.
Finally, Section 6, the final value verdict, where we tally up all our findings. After peeling back every single layer of these financial statements, crunching the ratios, and digging through the footnotes, it's time to tally up our findings. We've built the ultimate Buffett scorecard. On the bullet side, management absolutely deserves major credit. They have brilliant debt maturity management, meaning no immediate refinancing cliffs, and they sit on a massive $9.1 billion cash cushion that makes them incredibly resilient to short-term shocks. But on the bearish side, their reliance on issuing debt to fund outsized shareholder returns, combined with high leverage that artificially juices their returns and a genuinely terrifying negative tangible book value, well, that makes us extremely nervous. Which brings us to our definitive verdict for this explainer. While PepsiCo is undoubtedly a stable, cash-generating giant of a business, we would absolutely not invest our personal net worth into it based solely on this balance sheet. The aggressive use of leverage to mask equity dilution and the total lack of tangible book value completely violates our core principles of capital preservation and margin of safety. It really makes you wonder, doesn't it? If a blue-chip consumer staples financials rely this heavily on leverage and the premium paid for past acquisitions, what is really backing the investments in your own portfolio? Are you actually buying hard assets or just a really well-managed debt structure?
Take a good look at the companies you own today and ask yourself that exact question. Thanks so much for joining me on this deep dive.